Question 14. How can a remitting customer know whether the bank branch of the beneficiary accepts remittance through RTGS? Answer. For a funds transfer to go through RTGS, both the sending bank branch and the receiving bank branch would have to be RTGS enabled. The lists are readily available at all RTGS enabled branches. Considering that more than 26,000 branches at more than 3,000 cities/towns and taluka places are covered under the RTGS system, getting this information would not be difficult. Question 15. What is RTGS? Answer. RTGS stands for Real-Time Gross Settlement, which means that it enables money to move from one bank to another on a real-time and gross basis. Simply put, real-time means the beneficiary bank receives the instructions for fund transfer immediately, and gross means that it is not bunched with any other transaction and settlements of funds transfer instructions happen individually. Since the funds settlement takes place in the books of the Reserve Bank of India, RBI, keep in mind that the payments are final and irrevocable. Question 16. What is an EFT? Answer. An EFT stands for National Electronic Funds Transfer and is a payment system which facilitates one-to-one funds transfer. Like RTGS, an EFT also transfers funds from one bank, but unlike RTGS, the settlement takes place in batches that may include transfers from various individuals rather than individually. The batches are settled in hourly time slots. Question 17. How is RTGS different from NEFT? Answer. Timing. As mentioned above, NEFT operates in hourly batches. Currently, it has 11 settlements from 9 am to 7 pm on weekdays and 5 settlements from 9 am to 1 pm on Saturdays. So, in case you initiate a transaction after a settlement time, you have no option but to wait till the next settlement time. But that's not the case with RTGS transactions. Since they are processed constantly throughout the RTGS business hours, the service window for RTGS at banks is available from 9 am to 4:30 pm on weekdays and from 9 am to 1:30 pm on Saturdays for settlement at the RBI end. Keep in mind that the timings that each bank follows may vary. Amount. As far as NEFT goes, it does not have a minimum or maximum limit of amount you can transfer, but the maximum amount per transaction is limited to 50,000 for cash-based remittance and remittance to Nepal. As far as RTGS goes, it is mostly meant for large transactions. The minimum amount that can be remitted through it is 2 lakh. RTGS does not have an upper ceiling for transactions. Charges for NEFT inward transactions. When you receive funds via NEFT are free, as no charges are to be levied from the person to whom funds are being transferred to. When you use NEFT to make an outward transaction, when you send funds via NEFT at a bank branch for amounts up to 1 lakh, the charge is up to 5 plus service tax. For transactions above 1 lakh and up to 2 lakh, the charge is UP to 15 plus service tax. For transactions above 2 lakh, the charges can't exceed 25 plus service tax. For RTGS inward transactions, when you receive funds through RTGS, are free. For outward transactions, when you send funds via RTGS, if the amount is between 2 lakh and 5 lakh, the charges will be up to 30 per transaction. If the amount transferred is above 5 lakh, the charges can't exceed 55 per transaction. Question 18. What is S4A? Answer. S4A new scheme has been introduced by the Reserve Bank of India (RBI) for resolution of stressed assets and bad loans of large projects. The S4A will cover those projects which have started commercial operations and have outstanding loan of over 500 crores. The purpose of the S4A is to strengthen the lender's ability to deal with stressed assets and put real assets back on track by providing an avenue for reworking the financial structure of entities facing genuine difficulties. The scheme is an optional framework for resolution of large stressed account. Question 19. What is the quick ratio? Answer. The quick ratio is an indicator of a company's short-term liquidity. The quick ratio measures a company's ability to meet its short-term obligations with its most liquid assets. For this reason, the ratio excludes inventories from current assets and is calculated as follows. Quick ratio equals current assets, inventories, current liabilities, or equals cash and equivalents plus marketable securities plus accounts receivable, current liabilities. The quick ratio measures the dollar amount of liquid assets available for each dollar of current liabilities. Thus, a quick ratio of 1.5 means that a company has $1.5 of liquid assets available to cover each $1 of current liabilities. The higher the quick ratio, the better the company's liquidity position, also known as the acid test ratio or quick assets ratio. Question 20. Difference between nationalized banks and private bank? Answer. A public sector bank is a bank in which the government holds a major portion of the shares. Government holdings are more than 50% in public sector banks. Private sector banks. 1. Private sector banks are owned by private lenders. 2. The private banks are managed and controlled by private promoters. Question 21. What is KYC? Answer. KYC stands for Know Your Customer. The objective of KYC is to enable banks to know and understand their customers better and help them manage their risks prudently. The process of KYC entails identifying the customer and verifying the identity by using reliable and independent documents or information. Commercial banks' balance sheet has two main sides, i.e. the liabilities and the assets. From the study of the balance sheet of a bank, we come to know about a system which a bank has followed for raising funds and allocation of these funds in different asset categories. Question 22. What is Mission Indradhanush? Answer. Finance Minister, in its attempt to revamp functioning of public sector banks, has launched a 7-pronged plan known as Indradhanush. The 7 elements include appointments, board of bureau, capitalization, de-stressing and empowerment, framework of accountability and governance reforms. Question 23. What is plastic money? Answer. Plastic money is a term that is used predominantly in reference to the hard plastic cards we use every day in place of actual bank notes. They can come in many different forms such as cash cards, credit cards, debit cards, prepaid cash cards, etc. Question 24. What is MCLR? Answer. The Reserve Bank of India has brought a new methodology of setting lending rate by commercial banks under the name Marginal Cost of Funds Based Lending Rate (MCLR). It has modified the existing base rate system from April 2016 onwards. As per the new guidelines by the RBI, banks have to prepare Marginal Cost of Funds Based Lending Rate (MCLR), which will be the internal benchmark lending rates. Banks have to set 5 benchmark rates for different tenure or time periods ranging from overnight 1 day rates to 1 year. Question 25. Why the MCLR reform? Answer. At present, the banks are slightly slow to change their interest rate in accordance with repo rate change by the RBI. Commercial banks are significantly depending upon the RBI's LAF repo to get short-term funds, but they are reluctant to change their individual lending rates and deposit rates with periodic changes in repo rate. Whenever the RBI is changing the repo rate, it was verbally compelling banks to make changes in their lending rate. The purpose of changing the repo is realized only if the banks are changing their individual lending and deposit rates. Question 26. How to calculate MCLR? Answer. In economics sense, marginal means the additional or changed situation. While calculating the lending rate, banks have to consider the changed cost conditions or the marginal cost conditions. For banks, the cost for obtaining funds is basically the interest rate given to the RBI for getting short-term funds. Following are the main components of MCLR. Marginal cost of funds, negative carry on account of CRR, operating costs, tenor premium. Negative carry on account of CRR is the cost that the banks have to incur while keeping reserves with the RBI. The RBI is not giving an interest for CRR held by the banks. The cost of such funds kept idle can be charged from loans given to the people. Operating cost is the operating expenses incurred by the bank's tenor premium. Denotes that higher interest can be charged from long-term loans. Marginal cost. The marginal cost that is the novel element of the MCLR. The marginal cost of funds will comprise of marginal cost of borrowings and return on net worth. According to the RBI, the marginal cost should be charged on the basis of following factors: interest rate given for various types of deposits, savings, current, term deposit, foreign currency deposit, borrowings, short-term interest rate or the repo rate, etc., long-term rupee borrowing rate, return on net worth. In accordance with capital adequacy norms,